Hey, what's going on YouTube? And welcome back to Tech Conversations. I'm your host Guillermo. It is April 14th. Stock market is starting to drop quite a bit right now, but we'll see what happens the rest of the day. Just a reminder, we will be doing a giveaway once we reach 100,000 subscribers. If you'd like to enter that giveaway, all you need to do is hit the like button down below. Make sure you subscribe to the channel and let me know in the comment section below what your favorite stock in the stock market is right now. Now, in today's video, I want to talk about selling covered calls, more specifically the risks involved. It may seem like it's very straightforward, very easy to do, but there are some risks that you should be aware of. Let's jump into this video, guys. So, when it comes to covered calls, or actually when it comes to selling options in general, remember you should only sell options on stocks you want to own. So when you're selling puts, you're selling calls, only do it on stocks you want to own. So let's say we really like Apple. We like to own Apple stock, but we also want to sell some calls on Apple as well. Well, we can do that, right? If we go over to Apple options here, we can go to the sell and then call here. Now keep in mind, there's a difference between selling covered calls and selling naked calls. Naked calls is when you sell a call by itself. It's uncovered. And this has limited upside profit potential, just like selling a covered call. But in theory, it also has unlimited loss potential. So stay away from naked calls. We're focusing on selling covered calls. And so what that means is that you're going to have to own 100 shares per contract that you sell. And the problem with that already is that that may require quite a bit of money depending on what stock it is. If it's on Apple stock, in order to sell a covered call, I need to have 100 shares of Apple, meaning I need to have about $13,220. Now let's imagine you do have that amount of money. You go ahead, you buy your 100 shares. Now you want to sell your call, right? So remember, the first thing you do, of course, is choose an expiration date. I like to choose the closest expiration date to me. I feel like we have a better idea as to what the stock is going to do the closer the expiration date is to us. Then the second thing you do, of course, is choose the strike price, right? Which contract do I want to sell? So remember, you should choose a strike price, and that price should be the price that you're comfortable potentially selling your shares at. Never choose a strike price just because it has high premiums. Choose a strike price where you would be comfortable selling your shares at. So let's say I'm comfortable selling my 100 shares of Apple at $135 per share. I would sell this call right here. When you sell a call, you receive a premium. I'm going to receive 31 cents per share here. Remember, each contract is 100 shares, so I'm going to receive about $31. And so that's basically how this ends up working. But with that being said now, let's actually talk about some of the risks involved here, okay? So first of all, what's the worst thing that can happen to us when selling a covered call? So I'll demonstrate that actually by kind of taking a look at this with the options profit calculator. So they have a covered call option here. So let's go there and let's actually just take a look at what this looks like. So again, we're using Apple here. So we can click on Apple, get price here. Again, we're buying 100 shares. So it's going to cost us about $13,314. And then we're going to write or sell our option. So again, I like to choose the closest expiration date to me. Strike price, remember we chose 135 because we're comfortable selling our shares there if we have to. And then we're going to click here. So we're going to receive about $49 for selling this call. So let's calculate this here. Now I want to focus on this up here. So we're going to receive a net credit $49 for selling this call. But look at our maximum risk, $13,264.90. This is if Apple goes to $0. This makes sense, right? Because we're paying $13,314 for the shares. If Apple goes to $0, we lose all of that money. But remember, we received $49. So if we take this and subtract 49, we get this number right here. Okay, now if we take a look down here, our maximum return, $235 at a price of $135. Again, that makes sense, right? Because we're receiving $49, and if the price of Apple is above $135 on expiration date, we're going to be forced to sell our shares at $135 per share. Remember, we're buying each share right now at about 133.14, and then we're selling it at about 135. So we're making about another $185 there for selling our shares at 135. So 185 plus 49, it's going to get us close to that $235. So the worst thing that can happen is the stock goes to $0 and we would lose this much money. Now the probability of that happening is very close to 0%. Now, with that being said, let's talk about a different scenario. This one's a lot more likely, and one thing that you should always be aware of. So I'm going to use Plug Power for this, okay? So we go over to Plug Power. Let's say you bought Plug Power a month ago. A month ago, Plug Power was at $47. Let's say you bought 100 shares of Plug Power about a month ago, $47 per share. Now it's down to $28. You want to sell calls to make some money. Well, let's take a look here at the options and see why this is a big problem. So since we bought Plug at around $47, we really don't want to have to sell it for less than $47, which means we really don't want to, we don't want to choose a strike price lower than 47 because we wouldn't want to sell it for less than $47 a share. Well, the problem now then is if I go to the $47 strike to sell a call, look how much it gives me. $1. $1 for selling this call. So the other big risk here is if you buy a stock and that stock drops 20, 30, 40% in a few weeks, it's going to be really hard to sell covered calls at a strike price you're comfortable selling your shares at, because the premiums on these contracts are going to be very, very low. As you can see here, right? If I would have bought Plug a month ago, now I wanted to sell a covered call right now, I'm only going to get about $1. I mean, even if I chose like 42 strike, I'd only get like $2, right? So that makes it very difficult, and that's certainly a risk that you need to be aware of when selling covered calls. And again, yes, I could sell a call down here at 29, get $71. But if Plug goes up 10%, 20% tomorrow, I'm gonna have to sell my shares at $29 a share, right? So again, that's something you should always be keeping an eye out for. Now, those are kind of some of the risks involved if the stock drops. Let's talk about some of the risk involved when the stock rises and you're selling a covered call. And I'll use this with Microsoft. And this is a mistake I actually made, and I've made it with Microsoft. That's what I want to use this stock here. So let's go to Microsoft. I actually sold a call from Microsoft that expires this Friday. And let's take a look at the strike I chose. $250 strike. Microsoft has gone up a lot in the last 2 weeks. And so this is what is known as opportunity risk. If the stock goes up when you're writing or selling a covered call, you give up some of the stock's potential gains if the stock goes up a lot, right? So the problem here is that if Microsoft stays at this price on April 16th, I'm going to have to sell my shares at $250 a share, even though Microsoft is at $255. So I'm losing out on over $500 worth of gains right now. Right? So this is a risk involved, right? You're capping your gains, especially if the stock goes up a lot. So this is why you should always be choosing strike prices that you're comfortable selling your shares at. Am I comfortable selling Microsoft at $250? Yes. But does it suck that could have been potentially selling it at $255? Yes. Now, one thing I do want to mention here is that if I let this expire on April 16th and Microsoft is still at this price, then yes, I'm going to sell my shares, 100 shares at $250 per share. However, there's another thing you can potentially do. This is called rolling over your option. And so here's how this would look like, guys. So what I would do is I would buy to close this call that I sold. So remember, to close out of any option, you basically do the exact same opposite trade for that exact same contract. So to close out of this call that I sold, I would just have to buy that exact same call. So I would go over here and I would buy this exact same call. It's going to cost me about $575. You don't want to pay $575, right? You're losing quite a bit of money there. So what you would want to do here is, instead of doing this, you're going to sell a call further down the line and not have to actually pay but still receive a credit. So to roll this over, I would buy to close the call I'm selling, and then I would go further out. Let's say I'd go to May 14th, for example, and I would sell a call expiring on May 14th. And now, as you can see, I can choose this one right here, right? I'm not going to lose any money. I'm actually still going to receive a credit. I'm still going to receive money. I'm going to receive about $48. And now what I did is I also increased the strike price. So now, if I am forced to sell my shares, it would be at $257.50 per share rather than $250. And again, I'm not losing any money. I'm still receiving a credit here, right? Because I'm paying less to close out of my contract than the amount of credit I'm receiving for selling this contract. So this is called rolling over your option. So you don't always have to let your option expire and give up your shares. Sometimes you can roll over your option if it makes sense to you, if you're comfortable doing it. And as you can see, now if I do sell my shares of Microsoft, it would be at $257.50 and I'm still receiving a credit. So again, that's rolling over your options. Now, the other thing with this here, and this is a question I get asked all the time, right, is if I go back here, again, you may see that Microsoft, the price for Microsoft is already higher than the strike price of the call that I sold. A lot of people ask me, well, how come you're still holding the 100 shares? Why haven't they been called away? Why haven't you been forced to sell them? Because early assignment rarely happens, guys, okay? You're rarely going to have to sell your shares before the contract expires. I've been doing this for about 1.5 years now. It's only happened to me once. The only time you need to be very aware of early assignment is when a stock has a dividend before your expiration date. Then you may be early assigned. But when it comes to these normal stocks and there is no dividend on that week, the probability of early assignment is very, very low. So again, even though Microsoft is way above my strike price here, I'm probably not going to have to sell my shares until this option expires. Okay, the buyer of this call that I sold is not going to exercise the right to buy these shares, usually, again, most of the time before expiration. So that's one thing I did want to mention. Now, one last thing, guys, to always note here, of course, is another risk, of course, is that you can be exposed to spikes in implied volatility. As a seller, spikes in implied volatility are not good for us. Because remember, implied volatility does affect the price of the option, right? Because anytime implied volatility goes up by 1%, the value of the contract goes up by what Vega is. And so if implied volatility goes up, the price of the option will also go up. And so it's going to cause the premiums to rise, even if sometimes if the stock has gone down, right? So maybe I'm sure you guys have seen this. You have 100 shares of a stock, you sell an option, the stock is going down, and then all of a sudden your total return drops a lot because implied volatility just jumped up a lot. So one thing to always keep an eye out for, of course, is spikes in implied volatility. And usually when you're selling options, you kind of want to find options with higher implied volatility because, again, the options or the premiums on those options will be a lot higher. So anyways, those are kind of the biggest things, the biggest risks to look out for when you're selling covered calls. If you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.